Welcome back. Now it's time for Forum Daily's weekly market update with Catherine Murray, host of the Buck Stops here. Take it away, Catherine.
Thanks, Nima. Hello, everyone, and welcome to your weekly market recap. I am Catherine Murray. We are seeing markets move higher this week, and the U.S. market's on track for 5 straight days of gains, with specific strength within the tech sector, and of course, the FANG Plus names also moving much higher, hitting some record highs, in fact. And it looks as though the S&P 500 and the NASDAQ are at 15-month highs. So again, a real rally in the broader markets, which is key and important as well, because so much of the move has been in the tech sector, but you're actually seeing a broadening out into other sectors as well in terms of investor participation. What's the most recent tailwind? Inflation. It did come in lower than expected this week, and that's been a key driver to this recent rally. It leads investors to believe that the financial conditions will be less tight than they have been, and that we will have a soft landing, not a hard landing. And importantly, as well, as I briefly mentioned, the market breadth is increasing. In other words, investors are looking at other sectors and feeling confident about moving into other areas of the market, the economy, other than just technology stocks. We also did get a reading this morning. U.S. consumer sentiment came in much higher than expected. So again, another positive on the economic data front. Now, of course, the bears are saying, look, we've got higher for longer interest rates. It will, in fact, lead to a prolonged, tighter environment for credit. And if that occurs, you will have the ensuing slower, lower growth. But again, it does certainly appear that the bull case is winning out right now. Front and center, of course, is the most recent earnings reports. And we kicked that off with the big banks in the United States this morning. And they came in better than expected. You had JP Morgan as well as Wells Fargo beating and increasing guidance. Citicorp did beat and reiterated their guidance. They, of course, did point out that investment banking has been slowing down. But nonetheless, all these stocks are moving higher on the day so far. Other earnings themes to be thinking about: the dampening pricing pressure on the consumer, just given the fact that inflation seems to be coming down. There's consumer resilience as well. And I think we'll want to hear a little bit about how companies are thinking about AI and the potential positive impact that might have on efficiencies. So a lot to watch there. In terms of where the strategists stand right now as relates to the back half of 2023, Goldman actually is looking for a move higher in the S&P 500. You've got Barclays increasing their year-end target to 4150 on the S&P 500. Stifel actually has 4,400 on the back half of the year for the S&P 500. However, Citigroup did move from overweight to neutral with respect to the U.S. equities outlook. And as relates to the Canadian markets and the TSX, we did, of course, have reached a tentative deal with the BC port strike. So that should be a positive. Of course, there was about $500 million in goods a day that was prevented from moving on the back of this strike. Total disruption is estimated about $9.7 billion. Away from that, the TSX is up mildly on the day, but is up only 2% on a year-to-date basis. And that is leading some strategists to say that perhaps the Canadian market might play a little bit of a catch-up to the U.S. market for the back half of 2023. Of course, composition of our markets are so different, with us being, of course, much more commodity and bank and telecom focused versus the U.S., which, of course, has the tech heavyweights that have been moving that market so much higher. But again, some strategists that they're saying maybe we'll see a little bit of catch up. Of course, the big news this week in the Canadian markets was the Bank of Canada raising rates by 25 basis points. That was expected. It brings the rate to 5%. That's the highest number, the highest rate we've seen since 2001. Of course, a lot of questions remain in terms of what that means for the impact on the Canadian economy and, of course, the Canadian consumer, really feeling the pinch as it relates to rents and of course, mortgages and just your overall interest payments on any debt or credit that you may have. So more to be seen and felt, I think, on that front. And we'll see what they do in terms of the next meeting. But of course, they have said, the Bank of Canada have said that they are very much data dependent. What to watch for next in the Canadian market? Take a look at the CPI that'll be out next Tuesday. And that might give us a bit of an indication in terms of the next move for the Bank of Canada. Nima, I'll leave it there. Back to you.
All right, thanks for that, Catherine. Again, that was Catherine Murray, host of the Buck Stops Here. Tune into her program every Sunday at 9 a.m. Eastern only on the News Forum Network. All right, we have to go to break now, but when we come back, we'll have more news from around the world, of course, so stay tuned. Forum Daily will be back.